Welcome you all once again to today's section. We are going to continue with the cash flow, pick one or two questions, and then use them as practice. So we look at our first question, which will be the Pale Limited. So that's example 4 from the handout. Pale Limited. Example 4, Pale Limited. Pale Limited. So let's go straight to the requirement. Prepare the company statement of cash flow for the year ended 31st December 2005 using the indirect method. Great. So that is now since we have to go through the footnotes one after the other. So note 1 states that during the year and the non-current assets, which are the cost of 800,000, with a current value of 350,000, were sold for 500. So we said that with this, you have to calculate the profit or loss on disposal. If it's a profit, you reverse it. If it's a loss, you reverse it. The profit, you subtract because you've added to the profit over there. And then if it's a loss, you have subtracted, you have to add back. And then the proceeds from the disposal will be added to that of the cash flow from where investing activities. Agreed. Good. And then that note ends there. So the proceed is 500 here. Then note 2, capital surplus increase from the revaluation of some land that was not being depreciated. So they're just telling you that the increase in the capital surplus is as a result of what revaluation. So you reflect it in the PPE calculation. Good.
So, were they expecting the loan to be depreciated?
No,
Because what is
yes, they are actually telling us some of land that was not being depreciated. You know, we also depreciate some land, the leasehold land, and then we don't depreciate freehold land because it does not have the useful life. Good. So that's why they were telling us that this particular land we don't depreciate. Okay, so note 3.
okay, that's
Yes, note 3. Okay, note 2. Let's go look at the changes in the capital surplus. Yes, important. So capital surplus opening balance is 1,000, closing balance 1,005. So it means that the increase will go to the PPE when I'm calculating for new PPE acquired during the year. Okay, don't forget that current year and previous year, current year and previous year. Please, anytime when you go there, when you get a question, kindly check and confirm these years. Great. Please, when you get a question, kindly locate. Other than that, you finish solving the question, and then if you use the current year as previous year and the previous year as the current year, oh, right, that's great. Let's make it two. Great. So in this question, the current year is 2005, previous year is 2004. Always locate it. It's not always the case where the examiner will bring the current year first and then the previous year second. So let's check it first. Okay, so note 3. The 2004 income tax liability was settled at the amount provided for at 31st December 2004. That is. So here it will pop up. So it means that the tax paid was the 2004 income tax provision. Yes, that will be the tax paid. If you calculate, you get the same answer. That's the implication. But it will pop up in the calculation. So such notes, they are just there for confirmation. Note 4. Additional loan notes were issued on January 1st, 2005. Interest paid on 30th June 2005 and 31st December 2005. So the interest was paid twice in a year, and then they say interest was paid. So we will go and check whether first there's interest payment or interest payable among the current liabilities. So here when you check, there's no interest payable. So that,
they pay all the
thank you. So they are not owing anyone. So that means the interest expense is the same as the interest paid in that scenario. So the same figure will be added back and the same figure will be subtracted at the bottom of the what? The operating cash flows. How we get it. Good. Then the actual loan notes issued during the year will be added to the financing activity. So loan notes of 50,000 would be, let's check whether it's 50,000. The loan notes, here's 2,000 and it has increased to what? 3,000. So the issue was 1,000. Good. Then the last footnote says that dividend paid on the year amounted to 750,000 cedis. So that's the dividend paid, 750,000. Now we'll go to financing. We are done. Then you scan through the financial statement as usual, Ralph.
dividends. Since we have the income surplus.
Good. So dividend paid, if it's not in a footnote, then we have to look for it in an income surplus account. Yeah. So so if they don't give it in a footnote, then I'll prepare a simple income surplus account or change in equity, and then they'll reflect it in there for you.
So the income surplus in the financial position, which one is it?
With that one, once there's dividend and once there's profit before tax, we are not going to touch that one because that's what that information that we need from it. That's what they've given us. However, if dividend has not been given to us, then we have to reconcile and find out whether if we add the profit made for the year to that of the income support at the start, are we getting the closing balance? If you're not getting the closing balance, then the difference represents what dividend paid. We are done. But once all these two are in the question, then we move on. But you can balance it. If you bring the opening balance, add the profit at the tax to it, less the dividend paid, it must give you the closing balance. So the answer will be the same. The answers are the same, then that means you're on the safer side, then you move on. So that's the dividend section. Now let's come to the financial position. So cost of valuation, the current assets, all of them are there. Accumulated depreciation, 5,600. For the cost of valuation, that means some of the assets were revalued. So 11,000, that's the cost for 2005. For
So
8,000,
that's the closing balance.
yes, the closing balance.
So the first one is the opening and then without opening.
No. The current year is the closing balance, and then the previous year is the opening balance. So we should check 2005 is what is a closing balance, right? And 2004 becomes what? The opening balance agreed. Good. So here we have to check for the years where how they have arranged it.
Okay, so then this one does it have to do with the balances? And this one
Exactly.
has a credit,
No, no credit, no debit.
debit.
No credit, no debit. Because they've done the two currencies, Two currencies means the first currency is for addition and subtraction. So if they want to add certain figures, they will add it at the first column, put the final answer to the last one. The last one is for the final figures. Then you put it there. Good. And then for financial position does not have a debit side, credit side. No. It just contains list of balances. So that's why we call it balance sheet. It's a sheet that contains list of all balances. In itself, it's not an account that which you have maybe debit or credit. No. But if you're recording all balances, you prefer putting them, grouping them, right? All debit on one side, so all assets one side have a debit balance. Then all liabilities follow, all equity follow. So they also have a credit balance. How we get it? And then we are saying that they must balance. Good. And then accumulated depreciation, 5,600 closing balance, 4,800 is what? Opening balance. Agreed. Good. Because of the year. Carrying values are there. Then current assets, inventory, receivable, cash at bank. Great. Then equity and liabilities. Exactly. So I mean, most of the question is part of it. So here, if you're looking
These
for
ones are current value, so they should have analyzed this place right so that they will
good, so if you check the current assets, inventory figure for 2005 is for 3,004. Receivable is 3,000. Cash at bank 2 is 400, giving us a total of 7,600. That's the current assets total. The same thing applies to the 2004 opening balance, giving us a total of 6,800. Now add it to the current value of the non-current assets. It will give you the total assets of 10,000 and then 13,000 respectively. So that's the scan. So here you check whether there has been increase in inventory, receivable, then you are done. So here with the inventory has what? Has gone down by 400. Receivables has gone up, and then go and check payable. Payable to has also gone up. Great. So basically that is it. So let's see how best we can work with this. Now let's go to the profit and loss. Have you seen this profit and loss? Very short. In the profit and loss, we need what? Only two items from the profit and loss. Item number one, our profit before tax. Item number two, all the adjustment that they've done there. The adjustment that we need from the profit and loss. There are two. One, the interest expense, finance cost, always in the profit and loss. Then from there you go to other income. And then you go to other income. So these are the two items that we have to consider from the profit and loss given to us. And that profit and loss, it must be for current year. In event where the examiner try to confuse you and make double year for the profit and loss, you still need the current year. Don't pick anything in the previous year. That one, there's no balance. No open balance, closing balance. Because the profit and loss is for a particular year, no balances. So you should take note. So if you check a question like Mo Limited, that one, everything is 2 years, 2 years. Profit and loss was also given for 2 years. So that one, you only pick information from where? The current year. Good. So here was the profit before tax. Profit before tax. Is it a 2650 or 2350? Good, 2350. So it's the profit which is before the tax. Have you seen that we've not named it? Yes, does not have a name. It's there for a reason. Good. So any profit which is before the income tax is profit before tax. Any profit which is after the income tax is profit after tax. So the profit before tax will be 2350. Then we say what? Immediately add the finance cost, the interest expense to it immediately. So immediately add back this 300. If you add back the 300, it will return you back to what? Profit before interest and tax. And that's the same answer that they had there. So let's go and start the question. Don't forget the three protocols: the name of the company, the requirements, and then the reporting currency. There are three protocols: the name of the company, the requirements, and then the reporting currency. Okay, so let's go straight to the board. Great. So we start again like this. The three protocols, we start by saying Hell Limited. Hell Limited. Good. Hell Limited. Then statement of cash flow. Statement of cash flows for the year ended. Let's move it up there. For the year ended 31st December 2005. We are done. Good. Here with the currency, you are allowed to report two goods. You are allowed to report them two with the currency. So let's check whether they are reporting in thousands or in millions or just a flat currency. It's in thousands, right? Good. So we have to do with the thousands there. So here, first one, Ghana City. Ghana City in thousands. Okay. So what do you do again? First, we said there's on a cash flow from where? OA. No shortcuts. So cash flow from operating activity. Just that we start with our profits. We start with the profit before tax. So write your profit before tax here and go look for it. So profit before tax. So what's the profit before tax in this question? So that's the first thing that we have to look at for. And it said to us 2350, right? So 2350. Immediately add back interest expense. So interest expense. Immediately, don't even rest. Interest expense happen to be 300. Put them together, get something like 2650. Tell the examiner that this profit is what? Profit before interest and tax. Okay. So basically, that is it. Then the adjustment continues. So adjustment for item number one on the list will be depreciation. So let's see depreciation. Record that one on the first currency. So depreciation here, let's see. They've not given it to us, so we have to find by ourselves. Wow. So if depreciation is not given, how do you have a depreciation? How do you get a depreciation charge for the year? You are going to use the method. And here we did something under IAS 16 when there's a disposal. there was a third step. So when the disposal, first step, add the proceeds, second step, calculate the profit and loss. What was the last step? Good, the remover. So you have to bring those adjustments here. That's all. So the depreciation, if we can go to the question and go to the accumulated depreciation there, open balance is 4,800. Good. And then we subtract what? The depreciation or the accumulated depreciation of the disposed asset from it. If you are not getting the closing balance, the difference represents what? The charge for the year. So that's how we do the removal. So the details must be cancelled or released. Then we get a closing balance. So if you want to look for depreciation, don't worry. Let's go through these three steps. Then you are done. So that's our first working. So workings. Workings. So the very first workings, this one will be on the third page. Your cash flow normally contain one and a half. One and a half. Good. So workings one is the depreciation. So I write here depreciation. Depreciation. And third examiner. That opening balance of the accumulated depreciation is what? 4,800. You ask yourself, is there any disposal during the year? Is there any disposal during the year? The current year, which is 2005 years. If there's any disposal, you take the accumulated depreciation of the disposed assets from it because we move on.
The opening balance of the accumulated.
Yes, opening balance of the accumulated depreciation. So accumulated depreciation. That is it. So opening balance of the accumulated depreciation. Great. Now what do you do next? Ask yourself, is there any disposal? So what's the accumulated depreciation of the disposed assets? Now, how do you find carrying amount from the IAS 16?
The current amount is the cost minus the accumulated.
Okay, so cost minus accumulated depreciation. I'll take that. But when you go to the question, note 1, let's go and pick the accumulated depreciation of the disposed assets. If it is there, note 1, right. So during the year, non-current assets, which are the cost of 800,000, cost is 800,000, the current value will not give you the three words at the same time. So cost is 800,000 with a current value of what? Of 350,000. So that means certain figure, which is the accumulated depreciation, has been subtracted from these costs before arriving at what? The carrying amount. Because carrying amount is nothing by the cost of the asset less what? Any accumulated depreciation. So if the cost is 800,000 and carrying value is what? 350, that means the accumulated depreciation has been subtracted already, and that's the figure that we are interested in, we are looking for. So how do we find it? So therefore, the accumulated depreciation will be if cost, if 800 minus something. Sorry, a certain figure. When we take it from 800, now giving us a carrying amount of 350, right? So what is the accumulated depreciation of the disposed assets? So the 800 minus what, the 350. Then we are done. 800 less the 350. That will give us the accumulated depreciation of the disposed assets. So yeah, I'll tell the examiner that it's nothing by the 800,000 minus the 350. But that will be 800 minus 350 because we've written $3 already. Should repeat the full figure. Good. So therefore we get something like 450. Are you going to add or you are going to subtract? Disposer, you have to subtract. Agreed? So, so then you write here charge for the year, depreciation charge for the year. Leave it empty or put X there. We don't know. That is what we are looking for. Always. You double underline it, then you record the closing balance. What's the closing balance? Now the closing balance must be given to us in the question. So if you check the accumulated depreciation, the closing balance is 5,600. Perfect. So the question is this: if I add all and I'm not getting the 5,600, then the difference represents what? The depreciation charge for the year. How we get it? That's how we arrive at the depreciation charge for the year. So 4,800 less 450. So that will give us 4,350. Then the difference between 4,350 and that of 5,600. Okay, so 1,250. That's perfect. So 1,250. Great, 1,250. So that's the depreciation charge for the year. That's reference number one. That is on reference one. So let's go. And then to the adjustments. Record here 1,250. And then try and tell the examiner that she go to reference number one. You'll find it there. Okay. So basically that is it. Then we are done with the game. And is there any other adjustment that we have to do? So, alien, the profit on disposal, right? Okay, so what's the profit on disposal? Now let's go to the
How about the proceeds? Or that one have been added to cash already.
good. The proceeds of the disposed asset will go to the investing activity. We'll go and then add it there. Good. I will get it. Here they have treated it. It has been accounted for already. They have added to the cash. And I want to know why that cash balance is that figure. So we are going to perform all the calculation. Just that we are not using the cash flows. We are using profit. We are massaging profit to get what? The cash. Uh-huh. So we are going to include it.
The other income. So the other income, you don't have profit or loss.
Mhm.
Other
So we have to find the profit or loss on disposal. The asset was sold for 300,000, sorry, 500,000, but the current amount was what? 350, agreed. So there was a profit of what? 150,000, which must be reversed for two solid reasons. Reason number one, it is alien. But when you sell something and you record profit, that one is not when you sell your PP, any of your non-current assets, either profit or loss that are going to derive from it. It's not an operating activity, it's an investment activity. But in a profit and loss, we don't have profit from operations, profit from investing, profit from financing. No, we don't have that. So all of them go to one basket. So that's why we are taking all of them out and then getting it. Good. So there's a profit of 150. We are going to reverse it. So how they've treated it, do the opposite. So that is it. So here will be profit on disposal. Profit on disposal. So open your bracket nicely. Then what you do is they sold it for 500. No, the carrying amount happened to be what 350. Then record the answer here 150 profit. Because the profit you have what added to the profit. So what do you do? Reverse it by subtracting. That is it. Okay. So that is the alien. Then check again. Is there any other item, investment income? If there's no other item like that in the question, move on to changes in the working capital. Now, when we check here, there's no other item again. So we are going straight to the changes in working capital. So now let's quickly go to the changes in working capital. Changes in working capital. Changes in working capital. Okay, so the adjustment we can put them together. So 1,250 less 150 give us 1,100, right? So we get 1,100. You can also leave it like that and add a changes in working capital to it. Good. So what you do is you come here and then you record changes in working capital. Changes in working capital. No shortcuts in exams. Sorry. So changes in working capital, we looking at the three working capital item. The three working capital item. Good. So we will look at inventory, trade receivable, trade payable, whether there has been a movement, increase or decrease. So let's see. So let's go straight. Inventory. Inventories at the start was 3,800. So at the end is 3,004. So that's what decreased by 400. So here, just tell the examiner, decrease in what? Inventory. Short, then open a bracket, perform the workings, you are done. So all what you have to do is tell the examiner that decrease in inventory. Decrease in inventory. Can you open a bracket? Tell the examiner that it was 3,800 less 3,400. And what do? Throw the answer in. Answer will be 400. You know, decrease in inventory is what? It's an inflow or outflow. So, so inventory has gone down. What is the implication? Have you received money? If inventory gone down, we've received money. So money is in. So when money in, we call it inflow. So it should be positive like this. We leave it positive. Then you go to receivable, trade receivable. So trade receivable. So it has increased from 2009 to 3,800. So which has increased by good. That's increased by 900. So tell the examiner increase in trade receivable. Open a bracket nicely. Let's come down. Okay, so that'll be in fact 3,800 plus 2,900. That'll be 500. Now, when receivable increases, what's the implication? Is it inflow or outflow? It's outflow because money is going out. So we put in bracket nicely. Now let's go and look at for the payable, the trade payable. So trade payable to let's go down there for trade payable. It's 900, right? Good. In fact, it's 900, not 500. Sorry, 900. Okay, be 900. So let's go to the trade payable. Trade payable has increased from 3,200 to 3,700. Inflow of what? 500. So trade payable 322. So right, increase. So what we are interested in, increase in trade payable. Open a bracket. That is that it's nothing by 3,700 less what? 3,200. And this will give us 500. Increase in payable, is it inflow or outflow? Inflow, because money is coming in. Why? Because the suppliers have given us more goods or more cash in the form of goods. Great. So that is it. Now let's sum them up. So down, another down, down again. Okay, good. Now we sum it up and we should with the what you get. I need answer. Mm-hmm. It's negative. Okay, so 900 minus 900, that will give us 0. So, first, I need that answer 0. I'll mark it for you. 0. Okay, so that is it. So you add all this, then you get what you call operating cash flow before what? Interest and tax. So we've been able to massage this profit well to arrive at what? Cash flow. The cash version of the profit before interest and tax is this answer. So putting these two together, 2,650 plus 1,100. Good. So 3,550. So I think I'll continue from the other section. I'll continue from the other section. So I'll throw the camera up again. So great. Now let's see. So let's continue the game. I'll continue from this side. Good. Then we move on to second right from the extremely top. So here we will call it cash operating cash flow from where? Operating cash flow, operating cash flow before interest and tax. You'll be able to master this profit before interest and tax to arrive at what? Cash flow. So operating cash flow before interest and tax. And that figure is 3,350 agreed. So something like this.
3550.
Okay, so 3,550. Yes, so something like this. I'll put it down. Then what do you do again? The two items, the tax paid and then the interest paid. So I'll bring the interest paid here. Interest paid. The interest paid will be here. We said that in this particular question, there's no interest liability stated on the financial position, the balance sheet. Among the current liability, there's no what? Interest liability there. So if there's no interest liability, then it means that they are not owing. If you are not owing any interest, then the interest expense is same as what? Interest paid. So just carry this figure, the interest expense here, just carry it here as what? Interest paid again. Why? Because they are not owing interest. In fact, even if you calculate, you still get the same answer. Let's see. Anything paid, there are three steps. So if you're going to calculate it, let's say interest paid, if you want to do it, you get the same answer. You start by saying that opening balance, they are not owing, so dash. Then bring interest expense. Interest expense is what? 300. Then say closing balance. They are not owing anything, so closing balance is dash. Normally subtract the closing balance. So this is the interest paid. Putting everything together, you get interest paid. Just that if there's no interest owing or accrued interest or interest expense, interest liability on the financial position, the balance sheet, if there's no interest on the balance sheet, then there's no need for you to go through all this because this and this and this. This one, yeah, I'll give you one tick. Oh. If you do all this, I'll give you one tick because there's no figure here. That is it. So basically, that is the interest paid. Now let's go to tax paid.
So what if like you the 10% interest typically was 200 and then it increased to
Mm-hmm.
300. So
Yeah.
you will assume that the difference
Mm-hmm.
the difference of 100 is what the additional.
Exactly. And once we have used the 3,000, the increment has been factored in already. If they are still stating it at 2,000 or 200, that's why you have to calculate additional interest and charge it accordingly. Great. So that is the interest paid. And the next item will be tax what? Paid. The last line item. Don't forget that the interest paid can also be recorded as what? Under what? Financing. If you're not a bank, record it under financing. Good. The Apple Limited, if not inform us, they are ordinary activity. So you can't tell me whether it's a bank or it's a what? It's a normal trading company. So by we fair putting it here under the operating activity. So the same way if you place the interest paid under finance, you are not wrong. You are assuming that this company just incur interest when the company go for finance. That's when you go for loan. Okay. But that's been the best situation or the best solution for this. Because this is not a bank. Yeah, this is
It
not
should have come to finance.
yes. So this is not a bank. Good. So must go to the financing. Okay, I like that. Okay. It's true. It's true. Please let's check the calculations. Let's check the calculations. There is 265. Okay, 2650 plus 1100. I like that. So it must give us what 3750. Good. So it must be 3750. Great. So 3750. Perfect. So let's see 3750. Now let's go and calculate the tax paid. Let's go and calculate the tax paid. In Adom Limited, I'll put the interest paid at financing. Adom, I'll put the interest paid at financing. Great. Now let's move on. Tax paid. So that will be workings number 2.
Yeah, with the interest.
Okay, so workings number 2. The interest, because of there's no opening and closing balances, so the same as the interest expense. Uh-huh. Great. So the working number two, the tax paid. The tax paid, that one to three step. So opening balance of the tax liability, opening balance, income tax expense, and then the closing balance. We are done. So let's go to the question. So let me write the income tax expense here. Income tax expense, then the closing balance, then that's all. So from this question, what is the opening balance? Here, the opening balance, if you see deferred tax in the question, can we put them together? If there's deferred tax in the question,
How do you put them together?
good. So let's assume that this question, if you check the non-current liability, there's deferred tax section. If you check non-current liability, there's deferred tax section. Good. Uh, so basically, that is it. Good. Now let's go to this particular question. Assuming that there's deferred tax at the non-current liability, there'll be a figure at both current and previous, so opening balance and closing balance. And still, there's income tax at the current liability section. Wow. Then that's good news. All what you have to do is when you pick the opening balance, the one at the current plus the one at non-current, put them together and get just one opening balance. Good.
Or you add the opening
So
balance.
you add the one at the current liability, which represent the current year tax owing, plus the one at the non-current, which represent what? The deferred tax liability. Good. So that is it. Just that in this question, we don't have deferred tax liability. So the open balance will only be the current tax or the current year provision. Good. I hope it's a bit okay. Now let's continue the game. So the opening balance is 600, closing balance is 700, income tax expense is 700. Let me take it again. Opening balance is what? 600 here, nicely. Closing balance is here, 700. And then the income tax expense, the one that is in the income tax state, the profit and loss statement, that's the income tax expense, which is also what? 700. So that is it. So now the opening balance is 600. Don't forget your currency. Opening balance 600. Income tax expense is 700. Then the closing balance too happen to be 700. So what's the tax paid? So this one is to cancel. Tax paid is what? 600. And now was a note that the examiner was telling us that the income tax liability provided for 2004, which is the 600, was settled in 2000 and was a tax that settled in 2005. So this 600 that they made provision for, that's what they paid here. So it's reflected. That's what I said. That note is just a confirmation.
Okay, so the last 2004 is 2005.
Yeah.
Then
So
the three, we should change it to 2005.
exactly, it was settled in 2005. The income tax,
December.
the income tax provided for 2004 was settled in 2005, just for confirmation. So that's the note 3. Good. So whether that note is there or not does not make any difference. Do not
This
change
one
it.
I'm a bit confused with the closing balance. Why we are subtracting?
Okay, always still closing balance less.
Oh, okay.
All closing balance is less. So the formula say okay, open balance add, then add a movement to it, less the closing balance. Now let me explain why we are lessing closing balance. At the start of the year, you are owing the people 600. And then that year, you owe them again another 700. So what's the total debt? 1,300. So if I should end here, you are owing them 1,300. Okay. Just that at the end of the reporting period, you owe them just 700. So when I take it off, it will give me how much I paid during the year. So that's why we are subtracting. Good. So when I take it off, so if I'm owing you in total 1,300, and then now I left with just 300. Okay, then that means I've paid you what? 1,000 cities. So that's why we are subtracting the closing balance. And it applies to all, anytime you're looking for something paid or something received. That's all. Something paid or something received. That's how we go by it. Okay, so I'll put the tax paid here, 600. I'll put in brackets. So the net cash flow. So this will be net cash flow. Net cash flow from where? OA, operating activity. So taking this one off, 600, that'll give us 315. So that's 2850 aggregate. 2850 if possible. 2850 good. So 2850. Then you move on. We are done with the cash flow from where? Operating activity. We said that for cash flow purposes, the organization's activities are grouped into three. What are they? Operating activity, financing, and investing. We are done with the operating activity, so we can go to what? Investing. We are going to write cash flow from investing activities. So the next line will be cash flow from investing activities. Agreed. Cash flow from where? Investing activities. So no shortcut to it now. IA. Cash flow from where? IA. Investing activities. Now with the investing activity, we say it talks about non-current assets. Everything about assets. Buying assets, selling assets. That's all. What has not formed part of your core activity and then you enter into it, it's a what? An investment. So which must be accounted for. This year you want direct cash flows, you want money, not profit. It must be money. We are dealing with cash flow. Good. So first we look at there's a process there. Please record the easy ones. They show some plants or some buildings. So proceeds from disposal. And yet there must be two currencies. So proceeds from disposal. Proceeds from disposal. What was the proceeds? We had 500, right? They sold it for 500. So I record it here. 500. Would it be inflow or outflow? Proceeds, inflow. So they are receiving what? Money. Money is coming in. So it should be positive. Then is there any investment income? In this question, no investment income received, dividend received, interest received, rent receivable, anything received which is other than their normal receipts. Then almighty, this one is very important. Acquisition of PPE, acquisition of what? Of PPE. Now in the question, kindly confirm anytime there was disposal, when you do the calculation, you get acquisition. Anytime there's acquisition, when you do the calculation, you get disposal. That is it. Uh-huh. So we will tell you that okay, the company sold some of the assets, but still, if you find a difference or if you calculate it, the asset that they've disposed is now going up. No, it's supposed to come down or it's supposed to reduce, but it's still going up. So that means there's acquisition. How do you do that calculation? Is I'll take this section off and do that calculation there. It's a workings that we're going to do. We call it acquisition of PP. Acquisition of what? PP. So let's go and do that calculation. Acquisition of PP. I'll do it here. That'll be workings number 3. Workings number 3. So workings number 3 will be, take this section off. So have you seen that when you need a workings, you pause and do it. Don't do all the workings when you're done, then you can't prepare the. No. Just if you cannot do it, you move on to the next one. You leave it empty. Or you write your date of birth there and move on. Then go to the next one. By the time you finish, at least that's something for us. So workings number 3, we are going to call it acquisition of PPE, or just call it PPE schedule. You can also call it PPE schedule. So PPE schedule. Now here, keep it smart and keep it simple. Keep it a bit understandable. There are so many methods, but let's use this one, which will apply in every question. Any question, this one will hold. This bracket, right here, carrying amount approach. You are using what you call carrying amount approach. So pick the carrying amount of the assets. Tell us the opening balance. What's the opening balance of the carrying amount of the PP? So let's go to the question, go and pick it. Okay, so the opening balance of the current amount is what? 3,002. So opening balance is 3,002. Perfect. So I record here 3,200. Great. Opening balance 3,002. Now what do you do again? Ask yourself what goes to PPE schedule. Bring all of them here. PPE, what goes into PPE? PPE, if there was depreciation charge for the year, right? Must enter here if there's disposal. So let's what's the depreciation charge for the year? Let me record that one before I forgot. So depreciation charge 1250. What about disposal? Also comes in, right? Yes, they show some of the PP. So the carrying amount, because you're using the carrying amount method, you have to less the carrying amount from the entire carrying amount. Good. So say disposal. It's not right disposal here, we will understand. Bring the carrying amount 350. Put it in bracket. Why? Because they dispose it of gold. So meaning to reduce the asset value or the asset that they have, we need to get the existing value. Is there any revaluation gain or loss during the year? They told us that the movement in the capital surplus is what? Revaluation that they had on non-depreciable land. So the capital surplus balance, where is it? Capital surplus, okay, yes, it's good. So opening balance is 1,000, closing balance is what? 1,005. So it has increased by 500. So that means during the year, they had a revaluation gain of what? 500. Please look and tell me the accounting treatment of revaluation gain. What was the accounting treatment? Yeah, the examiner assumed that you've done IAS 16 and you are superb in the treatment of revaluation gain. Good. So how do you treat revaluation gain? So you add it to the asset carrying amount. Then you add it to the OCI or the revaluation surplus or capital surplus. So that's why they have added so that they had what? 1,005. Okay, so here you come here and write revaluation. Open your bracket, tell the examiner that it's 1,005 minus 1,000. Please don't punch this on your calculator and throw the final answer in. And throw the final answer in. Final answer like 500. No, don't do that. Don't do that. Perform this calculation for us. 1, 2, 3. So 3 ticks for you. Okay. Is there any other item? Is there any acquisition on credit? If they've acquired PP on credit, you have to bring it. if they have acquired what? PP on credit. So we have to bring it if they have acquired PP on credit. In this question, they have not done that. It's not acquired any PP on credit. So what you do is you just leave a space here. So leave one space, then underline it like this. Then write the closing balance. So closing balance. Now with the closing balance of PP, the current amount of the PP at the end. So that's what.
5,400.
So the closing balance is 5,400. Yes, it's 5,400. Great. So we call here 5,400. Perfect. So now you balance it, you add all. If you go to the closing balance, the difference represents PP that is acquired during the year. So if add all, if it's not equal to, then the difference represents PP that is acquired during the year. PP that is acquired during the year. Okay. So if you add 3,200, if you take 350 from that of 1,250, so that is 1,900, 4,100 plus 500, that's 4,600. So what should we add to 4,600 so that we can get 5,004? So we should add 800 there. Okay. Okay. Yeah, that's perfect. So yes, 3,000. But like I've calculated the figure. So 900. This one gives us 4,100, 4,600. So plus 4 will give us, yeah, so it's 800. Agreed. So let's put 800 here. Call it cash. Call it cash. Into bracket the balancing figure. It's just the balancing figure, the difference. Cash. So that's the PP that is what? Acquired. PP acquired. Now, in the exams, the difficult section is the cash flow from operating activity. That's the difficult section. When you are done with the cash flow from operating activity, within some few minutes, you will finish the entire game. So this one, within some few minutes, you will finish the entire section. So let's go and record it. And the cash acquisition of PP 800, that will be inflow or outflow. Outflow, yes, because money is going out. If that's all, we sum them up, we bring it here to the next section. That'll be 300 negative. Good. 300 negative. 300 negative. That will be 300 negative. Great. Okay. Good, 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 good.
The cover of that.
Yeah. Good. So from here, what do you go to? Cash flow from where? Financing activity. So let's go to cash flow from financing activity. So cash flow from FA, financial accounting. I like, I'll underline it and put two columns there, telling us that all the information below are under cash flow. So all this one, so it's under financing activity. This one is under what? IA. Then what we did, this one was under operating activities. Okay, cash flow from financing activities, you are looking for only two items. Check the equity, check the debt, the non-current liabilities, whether they are increasing or they are decreasing. That's all. Any movement, record it. So first of all, let's check the non-current liability. We can check the equity. Let's go and check the equity and be sure that equity is not increasing. So equity, if you go down, 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 thousand, so there's no movement, right? So equity has no, if no issue shares, that's the implication. In capital surplus, we've touched it already. Income surplus with the dividends, we're not going to touch it, but kindly confirm the balance for me. Good. Open balance is 2,200 plus the profit after tax less dividend. Will it give us a closing balance of 3,100? That is it. If not, the difference represents something else.
which is if the difference is what?
In fact, where there's no dividend, the difference represents dividend. But here there's dividend, so and it will balance for you. So balance
So the
nicely
opening
for you.
balance is
Open balance is
2,000
2,200.
plus the profits of the year, which is
Profit after tax, which is the
profit after tax.
yes,
And that's
please.
the net profit for the year.
Good, that's the profit for the year. That
One
will give
six
us
1650, which is 3850.
okay. So the profit after tax is 1,650. Good, three. So 1,650 plus the open balance two.
2,050.
So 2,200, right? Good. So when you add, what do you get?
3,850.
Good, 3,850. Then you take off dividend. What's the dividend? Dividend is 750. So 3,850 minus dividend of 750. What do you get?
750.
Good, 3,100. So it confirmed the closing balance. When you confirm like that, then you are free to move on.
So I'll say that not taking that one. Then what happened?
You have to look for something and then not do the difference.
And
Now, and there's dividend in the question. And to like a war. That one, you just attribute the difference to other item in the profit and loss statement. Any other item that you can name. One the dividend. If it is like the difference is negative, then we can still start the additional dividend page. Yeah, good. So we've checked about that one too. So let's go to non-current liability. Loan note, it has increased by what? 1,000. So additional loan note issued. So additional loan note issued. So tell the examiner that loan note issued. Don't worry, open a bracket, tell the examiner that the balance at the end is 3,000 less the balance at the start. Loan note, so to give us 1,000, right? I hope it will be positive or to not be positive. I hope it will be positive or to not be positive. I hope it will be positive. So 3,000 less 2,000. Can you put the answer here? 1,000. The first currency. Okay, so to be positive, right? Or negative. Inflow, outflow. When you issue loan note.
this one, and the people issue or they have received.
Okay, good. They have received the money, but they issued the loan note.
What is so like a venture?
Exactly. You've issued the venture, somebody have to acquire it and give you the money. That's
So
the
it's an inflow.
inflow. So it means that they've received additional loan, additional money during the year. So that's inflow. Good. Then what again go to financing? You check again, is there any other item there? Share deal. And that's all, non-current liability, that's all. So you go to the dividend page. So what's the dividend page?
750.
Dividend paid is 750. So let's go and then record it. Dividend paid is 750. And that's the end of the game. Let's turn this one here to capture every part of this section. Could that be an interesting section? So dividend paid will be dividend paid is 750. You take it off, then get a net cash flow from where? From financing. So net cash flow from financing. Net cash flow financing. That'll be 250, right? But you're supposed to write net cash flow from operating investment activity. Uh-huh. So here we record 250 here positive. Now a good company, the operating cash flow, the net must be positive if you're a good company. Investment must be negative. Financing they depend. Any company that your investing activity is positive, your operating activity is negative. In fact, you are performing bad. Why? Because you are selling all your investments and taking money today. What are you going to capitalize on tomorrow? And then even your operating cash flow is negative. What you create your business for, you're not doing well at all about it. Okay, so that is it. Now, let's do some short exercise. Here, we are going to the extreme end. And that one, I want you to do that one first before you even start everything. So yeah, this is the game. Now this section is a bit crucial. So kindly be with us. You can score 3 marks even if there's errors in the calculation. So what we have to do is this. We have to underline this one, then sum all up. Starting from where? Starting from the net from operating activity, investing, and financing. Put all the three together. Then we will call it net cash flow for the year. Net what? Cash flow for the year. Net cash flow for the year. Net cash flow for the year. Now here I will not write anything there because you're going to play smart game here. Let's play a smart game. That figure you should not get it wrong. No. Then you add the cash and cash equivalent at the start of the year. We've explained the cash and cash equivalents at the inception of the program. So if I've not gone through, kindly use the first section to go through. Okay. So you go to your cash and cash equivalents at the start of the year. So cash and cash equivalents. Some of the items they look like cash. They are equivalent to cash, but they themselves now they are not cash at the moment. Good. So let me represent that one by Y. That's the open cash balance. Let me represent that one by Y. If you put these two together, okay, so this one represents the net of cash spent during the year or generated during the year plus your open cash balance. When you add it, it must give us cash and cash equivalent at the end. If you don't trouble, so let me put here balance brought down here and balance carried down, the closing balance. Good. So this is then you double underline it. All these two figures, you can get them from the question. This one is the Z. All these three figures, you don't need anything from our solution. You can get them. Now we can get the Z and Y first. So let's go and get the Z and Y first. Cash and cash equivalent at the end and then at the start. So let's go to the financial position. Go to the current asset section. And then let's pick it year by year. So let's start with at the start, 2004. Cash at bank, 2004 is what? 100. If there's any bank overdraft for that year, subtract it for that the same year. If there was any short-term investment, which the examiners have informed me that it can be classified as short-term cash equivalent, add that one also to it. How we get it? So the cash and cash equivalent include three items. So let's write them down. Cash and cash equivalent include three items. A difficult examiner or examiner that wants to make things look horrible for you can include all these three items in one question. Okay, great. So it includes one, cash in hand and cash at bank. So both cash hand and at bank. That's the first item. Second, short-term investment. But let them inform you. Short-term investment. Let them inform you that it is readily convertible. The last one is bank overdraft. You subtract bank overdraft. Good. So this is the cash and cash equivalent. So in this question, it's only one. So let's go. It's 100. So opening balance is what? 100. Closing balance is what? 400. That's all. So you can go and then put it down. So closing balance of 100. No, opening balance of 100 and a closing balance of what? 400. How we get it? So you call it nicely like this. Then ask yourself, there's a certain figure here, x. What will be x? A certain figure, when I add it to 100, I'll get 400. What's that figure? Okay, so that means here must be 300. Great. So it means that when you add these three items together, you must get to 300. If you add net cash flow from operating activities 2850 plus the investment activity 300 plus the financing of 250, you have to get to what? 300. If you're not getting 300, there's an error somewhere. If you're not getting 300, then there's an error somewhere. That is it. Great. Now let's see. Let's reproduce the. So if we review the depreciation calculation, that's the PP schedule. Workings number 3. So let's go there and just put the depreciation in brackets. So revaluation is 500. We left a space here. Then we went down. We brought a closing balance here to be 5,400. So if you add all this, it's not equal to the difference represent DP acquired. So yeah, therefore, uh, cash. So you say write cash here, balancing figure 3,300. Yes. So basically, this section will be affected, and that's all. So 3,300, and then the net cash flow will be. So we did this for a purpose. I did this one to illustrate some fact for you. So 500 positive minus 3,300 will give us, okay, 500 positive minus 3,300 minus what? 28100.
No, 2,800.
Okay, so 2880. Good. 2800. So that means if we sum all up again, it must be 300. So are we saying even if there's an error in the question, this figure must be correct for you? Good. So now when you sum it up, it must be, because that's the only issue that caused the harm. Okay, so that's the end of this question. So don't forget the style. Realize that the first scenario, there was an error, but still we maintain our 300. Good. So that's the strategy that we are using to give the answer. Correct. Okay. Great. So that's the end of the game. And double underline it, the closing balance. I've done that, but my double underline is not coming proper. So double underline the closing balance, and it must balance nicely for you. And that's the end of the game. So depreciation must be subtracted. Depreciation must be subtracted. Okay, so that's the end of the game. That is the end of the game. So Pell has been done. Correct. So we are done with the Pell. What left is Adom Limited. Okay, so basically that is it. But can you take that comprehensive insurance? I call it what? A comprehensive insurance. Yes. So if there's any error, at least these three checks or these three workings, you have to score them correct. Don't let any error affect that figure. Good. Okay, so that's the end of Pearl Limited. We can still have some time to go through Adom Limited. If you do have any question, kindly let me know before we close the chapter of Pearl Limited. Kindly forgive us. Today's ball look a bit horrible. Uh, we are working on that to resolve it quickly. Today's ball look a bit horrible. I cannot see anything good. Good. So now let's see. In fact, all the remaining questions are yours. I did not bring include a lot of questions, only few of them. So I'll scan through Adom Limited. Then you try it for me. So when you are done with Adom Limited fully, do as if you are doing or not doing. And then kill Mo Limited. Example 6 Mo Limited. Mo Limited. I like that question very well. That question, I need both direct method and indirect method, like Adom Limited. So we need both direct and indirect method. For that of More Limited, we need the direct and what? The indirect method. Good. Yes, so try. That question is very nice. It is extremely nice. Good. Okay, so let's scan through. Exactly. For the lease aspect, we just need the rental payment. The rental payment will be under financing activity. Then we are done. Great. There's a full version of Mo Limited. So it's there. But I need the direct and then the indirect method, especially I need a direct method for Mo Limited because Okay, so example 5 or question 5. That is where we are now. As usual, Ralph. So let's go to the requirement first. Required. Prepare a statement of cash flow for Adom Limited for the year ended 31st December 2016 in accordance with IAS 7 Statement of Cash Flows. Kindly use the direct method to show the cash flow from the operating activities and reconcile the operating profit to cash from the operating activities in the notes. I like that. It means that first we are using what you call the direct method. That's the first requirement. Use the direct method to show the cash flow from where? Operating activities. Because we said that the difference between the direct and indirect has to do with what? The operating activities. So that is it. Then when you are done, relax and come back again and reconcile the difference between the operating profit and the cash flow using what you call the indirect method. So the ending part of the question was just requesting us to calculate just the operating activity using what? The indirect method.
Yeah, using both direct
Good. So now the full question requires us to use the direct method for the full question. So when preparing your cash flow, use the direct method to prepare the entire cash flow. So operating activity, direct method, you go to investing, you go to financing, you are done. Then when you are done, relax, come back again. Come and prepare just the operating activities using what? The indirect method for us. By way of what?
add the
Note.
rest of
No, don't add the rest. Just the operating activity using what? The indirect method. Even that one, we need just reconcile the operating cash flow.
for the cash, the operating cash flow.
Yeah, just the operating section. So the operating activity. So that is it. Okay, so let's go to the top. Let's start the footnote. Note 1. You are also given the following information. Information number 1. Non-current asset schedule for 2016 is there. Wow. So when I prepare something like this for us, we don't need to still prepare the PPE schedule. They've done the PPE schedule for us, so we just have to um, copy it and paste it in our solution. So you can see cost at the start of the year, 72,000. Good. Impairment loss of asset 3,500. How do you treat impairment loss? Impairment. We said depreciation, impairment, amortization, the same treatment. So it must be reversed. Impairment is just a loss incurred on the assets. That one's not deliberate as compared to depreciation. Impairment and depreciation have the same treatment. And then written down of assets like inventory. Inventory written down. That one too.
So when does an asset become impaired?
Asset is said to be impaired if the carrying value exceeds the recoverable amount. So let's cite an example. You have an asset there, a vehicle. The value today is 50 million. But if you sell this vehicle today or if you use it to the end, you're going to receive only 40 million. That vehicle has been impaired because the value that you have is not the one you're going to what? Receive. So that vehicle is said to be impaired. So impairment occurred if the value of the asset, the carrying value exceed what? The recoverable amount. Good. So that's the
So it
impairment.
means impairment occurs when you want to do sales. Is that what it
No,
means?
impairment is not a deliberate action. There must be an indication. Unlike depreciation, where that one is a fact, it's systematic, it's static, that every year the asset value must drop. Impairment is not like that. Impairment, there must be indication. Something might trigger or suggest that this asset that you have or this asset The value, you will not get the same value if you should sell it today.
Yeah, because I'm asking whether you calculate impairment when you want to, let's say, dispose, you want to sell an asset, or it's
You
after
calc
the sale.
No, you calculate impairment when there's indication, when something suggests that you are not going to get that value.
So what are
You
the
are selling
indication?
something, or not even, oh, you are selling. You have asset that you are using it. You are not going to sell it. But something suggests that if you use it, you are not going to derive the actual value from it. So that asset, let's give example. You have a vehicle or your office, the office vehicle. Currently, the value is 50 million. Yes, I like 50,000. This is the book value. And then the recoverable amount. Let us know if you use this vehicle, you can only recover 40 million when you use this vehicle. Oh, then this vehicle has been paid. Because the value that you are getting from this vehicle, or the value that you get from this vehicle, something suggests that you're going to get what? 40 million. Then we take it off, so it has been impaired by what? 10 million. This impairment does not have cash flow. There's no monetary value. Money has not moved. You are just lying to yourself that you're not going to recover 10 million of the value, so you write it off against your profits. Impairment, there must be indication. Something must trigger that. And then there's a full section on impairment. So you get that lecture video and then go through it. It's the standards. That's the remaining part of the standard. All the standard, there are videos available. So I'll arrange all of them and then forward it to you. Then go through for me. Good. I suggest strongly that make sure that impairment, you've gone through everything about impairment. It's a very good or a very nice standard that's practical. We said that impairment, the difference between impairment and depreciation, they have the same treatment, but they are not the same. Their treatment are the same. We subtract impairment from the current amount of the asset. We also subtract depreciation from the current amount of the asset. Impairment, depreciations are expense in the P and impairment to the same thing, expense in the P and L, but they are not the same item. They are different thing altogether. Why? It's the arrival. How you arrive impairment is not the same as how you arrive at what? Depreciation. With the depreciation, you are telling yourself that your asset is going to what? Reduce in value for a specific number of what? Period. So let's say the asset will last for 5 years. Within that 5 year period, the asset will lose, let's say 5,000, 5,000 each year. It's that one specific. That one deliberate action determined by management to spread the cost over the asset's useful life. That's all. Impairments are like that. Impairments like sometimes you feel like you are losing, right? So sometimes they'll ask you, you'll be there and it's like, you're not feeling well. You're not feeling well. And it's that, okay, you are showing symptoms. They'll ask the first thing, go and test for COVID. So have you seen? So COVID is just like COVID is impairment. Unless you test before, you know that you have the COVID. So the same thing as impairment. So impairment, there must be an indication. It's not deliberate as the depreciation, where that one you have to spread the cost. No. Impairment, something must suggest that you are losing. That's where we can record what impairment. So if you are not losing anything, then there's no impairment. If I have 50,000, I can recover that entire 50,000, then there's no impairment. I will still depreciate the asset. But now I know that systematically the asset value must be reduced. Impairment is not like
Is
that.
it possible you depreciate an asset and still have an impairment on that same?
Oh yes, you can still depreciate asset and still have what? Impairment. Because if you go to the cost model, what are the cost model sales? The cost of the asset, less accumulated depreciation, less accumulated impairment loss. So the two can occur at the same time. But they must occur at the same time. Just that the impairment, that one is not a great action. There must be indication. Okay, what will suggest? Give me maybe an indication or something that suggests that this asset you may lose a certain value from it.
Maybe when the asset is still
When the asset is damaged or it has involved in accident, one of your AC fell down. You know for sure that this AC As a result of this accident, I'm not going to recover the AC value. So the AC must be impaired. Yes, the AC must be what? Impaired. Good. You know, one critical example that is so funny. When you buy any organization, when you buy new vehicles or new assets, you put them in front, right? New asset in front. New vehicles. That one they'll be using maybe the good roads in Accra here, office, head office. From head office to maybe Accra. Good. As soon as this vehicle become old, sent to the bush, to the village. So that means there's an indication that this asset you may not get the actual value if you use it in Accra here. You won't get the value.
That's impaired.
So that means the asset has been impaired. So that's an indication. In fact, even if there's an indication, it does not even tell us that the asset has been impaired though, unless you test and see whether yes, if the asset has been impaired. How do you know? If the current value is what greater than whatever you can receive from that asset, that's all. If you know that when you send this vehicle to the village, the value will definitely reduce. You won't get the same value. That is it. That's why when you buy new cars, the throttle driver, they go on what? Long journey, right? Takrady, Kumasi, Takrady, Kumasi, Elubo, Nigeria. As soon as the vehicle become too old, Teshi, Nunga, Choko, Odoko, Kanesh. Come to Kanesh and pick a vehicle to, how do you call it? Mamprobi. Yes, exactly. So it means that that vehicle has been impaired. There's an indication. Something suggests that vehicle has been impaired. But sometimes that's not the case. You can see someone having a brand new car, in a village or using it to do some dusty work. That does not mean the car has been impaired though.
The person is okay.
Exactly. The person have the money, so like the cash is there. So that company every 3 years they change their vehicles. So all their vehicles are new. Whether village, whether city, the vehicles must be new. That's their policy. It does not mean that the vehicle has been impaired, not at all. So there's indication. Okay, now let's move on. So impairment loss, the treatment of impairment loss the same as depreciation. So you have to also reverse this impairment, right? Because it is what non-cash item. It is non-cash item. Impairment is non-cash. Money has not moved. So let's reverse it. It has been subtracted from the profit. So you go back and then what? Add. The next item is disposal. This is the cost of the disposed asset, 4,500. Agreed. If you come here to during the depreciation section, you can see disposal to the right. That's a remover. The accumulated depreciation of the disposed asset is also what? 4,000. So what's the current amount of the disposed asset? 500, right? Because the cost of 4,500 here, less the accumulated depreciation, which is what? 4,000, giving us what? 500. Agreed. So the current amount of the disposed asset is what? 500. Because the cost of the disposed asset is what? 4,005. Why? Because it's under the cost. This is the cost at the start of the year. These sections are costs. And these sections are depreciation. Good. Now let's move on. So yeah, charge for the year. So charge to profit and loss. That's the depreciation charge for the year, which is what? It has been charged to admin expenses, which is 2,000, right? So that's the depreciation charge for the year. Where do you treat it? You reverse it in where? Good. So the adjustment, you reverse it. So you add back. Then that's all. Then they will tell us how much they sold the asset for so that we can find the profit or loss on disposal. So if you go to the footnote, they say that fixed assets disposed of during the year were sold for 1,490. Meanwhile, the current amount is
That's
what?
the proceed.
That's the proceeds, how much they receive. Meanwhile, the current amount is 500. The current amount is 500. So there's a profit of 990. How? Proceeds less what? Current amount of 500. So 1,490 less 500. That will give us 990. So 990,000. Now, a good examiner should reflect this in the financial statement. Let's go to the profit and loss and check whether there's disposal, profit on disposal, gain from disposal, 990, right? So,
Yes.
so let's go to the profit and loss. You can see gain from disposal there. That's a 990. That's a good examiner. So let's go to the profit and loss for Adom Limited. Profit and loss for Adom Limited. Adom Limited. The profit and loss.
Okay.
Good. So
990.
so 990. This is coming from where?
The the profits.
Profit on the disposal. Great. So, but not all the examiner will do that. Yeah, all what I have to do is we just hide it somewhere. Just start from the profit before interest and tax. That's where I'll start from. So I'll cut the top off. I'll not show it. So from the question, we cut what the top off. We not show it. Great. Now let's continue the game. The next footnote states that, so the notes are not many. 4, right? Then you are done. Dividend proposed for the year amounting to 2,500. Dividend proposed. Now, when you see dividend proposed, they didn't say paid, so we cannot record that figure. We are looking for paid cash movement. Proposed means you declared it. Oh, directors, shareholders, members, please. In fact, we want to pay dividend, but we are going to declare a dividend of, let's say, 2,000, 2,500 for now, but we pay it later. So that one, there's no cash movement, right? Good. But check the financial position. When you see proposed dividend, always go and check the financial position. There will be dividend there. Check the current liability. So let's go. Current liability. So current liability is here. Anytime there's proposed dividend, it's under current liabilities, right? So that means there were some owings. So you have to find the actual dividend paid. Actual dividend what? Paid. So anytime you see proposed dividend, don't record it in the cash flow. Go and look for the actual dividend paid.
So the difference, right?
So what you do is you use the three-step approach. If you're looking for paid, something paid, open balance of that item plus the movement of that item, or declared, or the one that goes to the profit and loss, less what? The closing balance. You are done. You get the paid. So what I'll do is I'll pick the open balance. Okay, what's the open balance? Let's check the yield.
Versus 135.
So have you now here they've changed the style? Yeah, the current year rather is at the right, and then previous years at the what? Left. Go. So open balance is the one here. So the open balance is 13,350. That's the open balance of the dividend. And then the dividend proposed is 2,005. You add less what? The closing balance, which is 1,500. This is your closing balance. So anytime you're looking for something paid, don't worry. Something what? Paid. Anytime you're looking for something paid, the three-step approach, don't forget about that. The open balance of that item, add the movement of that item. Usually it's in the profit and loss. If not, they'll give it in the footnote. Less the closing balance. You get paid. That's all. So if there's no proposed dividend in the financial position, then the examiner will mention dividend paid to you. They'll mention dividend paid. Then you pick the dividend paid. We don't pick dividend, proposed dividend. No. We're looking for cash movement. Proposed dividend or dividend declared, they've not paid it until it has been paid. We want the dividend paid, not dividend declared or proposed. Good. So that's why we are massaging the dividend proposed to get dividend paid with the effect of the open balance and closing balance. Okay, so that's the dividend.
So, okay, how about taking the opening balance of the income surplus and then comparing it to the closing balance. You won't get
Okay.
dividend paid.
No, it will still give you the dividend proposed. Yes, it will still give you dividend proposed. Now the issue is this. If you pick the if you pick the opening balance of the income surplus, the difference, and then you add the profit after tax to it, and then if it's not equal to the closing balance of the income surplus, the difference will give you the 2005, the proposed dividend. Yes. So the difference will give you the proposed dividend. So let's try it and see. What's the opening balance of the income surplus? So let's go to the income surplus. 24,600. So let's pick it. 24,600 plus 7040. Profit after tax is 7040. So that will give us
31,640.
31,640. So if it's not equal to the closing balance, the difference is the dividend proposed. Less the dividend proposed, 2005. Proposed dividend, 2005. So let's do 2005. It must give us the closing balance. So the closing balance is 29,140 there. So that means it has balance. There's no issue. How we get it?
So it means still we didn't get the dividend paid.
Yes, still didn't get a dividend paid. What we get the proposed dividend. Once there was dividend in the current liability, you have to strike differences. You have to use the three-step approach. Once they are owing dividend and they declare some during the year, to get it paid, you have to now work back. Open balance plus the dividend declares less the closing balance. You are done, you get it paid. How do you get it? Good. I will forward another question again. That'll be the very last question. But that one, make sure that you've gone through all these questions before you solve that question. Yes. For those who want extra questions, I'll forward it to you. Try it. Be nice. Now, the third note or note 3 says that income from investment represents what? Interest and dividend received during the year. I like the word received. Once it is received, there's money movement. They have received the money. So I can, through free and well, put it where? Under the investing activity. So let's go. Investment, income from investment represent interest and dividend received. So let's go and see it. So let's go to the profit and loss statement. So income from investment is there. 1,000 what? 100. Agreed. So this 1,100, we have to include it in where? Investing activity. You have to reverse it in what? You have to reverse it in the operating activity because it is not an operating activity. It's an investment activity. So we send it to investment activity. And then that's the end of the game. Let's continue the note.
How about the dividend received?
So income from investment represent both interest and dividend received. So they are together. So the total amount is the what? The 1,100. Agreed. Good. So that is it. Okay. And the next note or the last footnote says that the prepayment is in respect of rent, which is part of the admin expenses. So there's prepayment. So let's go to the financial position. There will be prepayment. When they say prepayment and it's mentioned expense, so it must be part of what? Current assets. So do not go and look for it in the current liability. No. So go to current assets. So let's go to current assets straight. Current assets. Prepayment is there. Check the movement. It has increased by what? 50. So it has increased by 50. So it means that it has been subtracted in the profit and loss. So you add back to the expense. So definitely we subtract again. So 50 must be subtracted from the profit Because we said that the adjustment, you adjust for how many items? 3 items. Item number 1, non-cash. Number 2, accruals and prepayments. Number 3, alien, strangers. Any item which has entered this profit, but it's not part of operating activity, let's take it off. That's all. That's the adjustment. Plus the working capital. Okay. Now let's continue with the game. So now we are done with the footnote. Let's count through the item one after the other. Now the question is, why they give us the turnover, the sales, cost of sales, is to help us to prepare the cash flow from the direct methods. Using the direct method, because the direct method, we need the cash received from customers. To prepare the receiver's schedule, we need the sales. Good. So that's why it's there. So let's count through. Income from investment, we look at it. Gain from disposal, we look at it. Admin expenses, distribution cost, 1,002, admin 1,007. Look at all of them too. Profit before interest and tax is there. Interest payable, that is 900. And then profit before tax. So interest payable is 900. Let's check the trial balance. Sorry, the financial position, whether interest is part of the current liabilities. If there's interest there, then that means they are owing. And now you have to go and do the 3-step work. If there's no interest among the current liabilities, suggest that they are not owing. If there's no interest among the current liability, they are not owing. If there's interest there, meaning they are doing what? They are owing. I'll be get it. So here, if you check the current liability, there's no interest. I don't see any interest here. So that means Adom is not owing any interest. So the interest expense is the same as what? Interest paid. That's all. So interest expense is the same as interest paid. So the interest expense that we see of 900, where are you? This 900 is the same as what? The interest paid. So this figure will be treated 2 times. It will be added back and be subtracted finally. Yes. Here I will treat it under what? Financing, because this is not a bank or a financial institution. Adom Limited. I can see sales, turnover, cost of sale, gross profit. Bank, their operating activity does not involve of selling tangible goods. No. Good. So with this, let's add it to what? Financing activity. So the interest paid must go to financing. So that means the operating activity after the operating cash flow before interest and tax, you go to what? Tax paid. That's all. Then you're done with what? Operating activities. Great. Profit before tax, tax expenses there. We are going to use to calculate what? For the income tax paid. So let's come to the financial position too and look at the items that are what? Unusual. So this is our third illustration. So some of the item repeats itself. So non-current asset at cost, less depreciation. They give us the breakdown and we've scanned through the breakdown. So, and here there's no need for us to just calculate, go ahead and calculate the PPE schedule again. No, they've done it. Everything is there. So you just have to pick the figures in there. Then the current asset. You can see investment there, right? That's a short-term investment. Good. Now here, this investment, the examiner did not inform us whether it's a short-term or whether it's we should classify as cash and cash equivalents. We are going to deem as what? Ordinary investment. So we are going to deem as investment. So you compare the open balance to that of the closing balance. That's the open balance is what? 8,000. Closing balance is what? 6,000. So have they disposed some of the investment or they've acquired some of the investment? So they have disposed some of the investment because if you have 8,000 and now you have 6,000, then that means you dispose of what? 2,000. Where will it go? Go to investing activity and to be what? Inflow. Money is coming in because when you sell, you get money. Good. So to be inflow, going to a investing activity, then you are done. So that's the investment. However, in some situation, when you see investment under current asset, the examiner will tell you that this investment um, can be convertible to known amount of cash within some short time. So you can classify it as what? Cash and cash equivalent. That's it. So that one, we will add it to our cash and cash equivalent. How we get it with that situation? Good. The question that I will send to you, there's a situation like that in it. So where the investment will be classified as what? Cash and cash equivalent. Normally, if it's under short term, then you are done. Then you go to your inventories. If you are using the indirect method, you compare opening balance to that of the closing balance to know the movement. However, if you are using the direct method, cash received from what? Customers, the three step, cash received, opening balance of the receivable, then add sales to it, less closing balance. That's all, give you the cash received. The same thing, cash paid. But with the cash paid here, there's no purchases. You have to find the purchases for us. Yeah, because how do you find purchases? If you know cost of sales, you know open inventory, you know closing inventory, then you can find the purchases. Because here the examiner assumes that when it comes to profit and loss matter, in fact, the way you are good at it, So that's why it can be moving you. Yes, it can be moving you. Good. So if you want to get the purchases, we have open inventory. So you bring it, you bring the pages, you leave it empty. Bring the closing inventory, put it there, then bring the cost of sales, then find the difference. Or you do the reversal. Bring the cost of sales and reverse the open and closing inventory from it. That's all. So cost of sales. Now what do you do? Add back closing inventory and less what? Open inventory. Then that's all to give you the purchases. In a tight situation where cost of sales is not given or where you can't get the purchases, then we have to use the cost of sales like that as the purchases. Good. And let's continue scanning. Cash at bank and cash in hand. So cash, so that's the cash and cash equivalent. At the start is what? 8,000, at the end is 9,740. So don't forget the balance. So that means what will be um the net cash flow for the year. So if the closing balance is 9,740, what should I add to that of 8,000 so that I can get 9,740? So the total cash and cash equivalent at the end of the year will be, so that's 1,740. So if you do everything, the net cash flow for the year is 1,740. You've balanced it ahead of time. If you add, it's not giving that answer, don't worry, don't even change your solution and go ahead. Good. Then get the prepayment. We've talked about prepayment. Equity. Ordinary share capital. At the start is what? 60,000. At the end is what? Good. At the end is 75,000. So they've issued shares during the year, which is costing what? Or for a value of 15,000. Here, um, let us be factual. When shares increases or share capital increase, it does not necessarily mean they've received cash. They can issue share for free. Bonus shares are there. So normally a good examiner informs us that they've issued shares for cash or they've issued shares for bonus. A bonus shares or let's say 5,000 cedis. So that means if the total movement is 15,000, 5,000 is what? Bonus. The remaining part was what? For cash. So we are looking for cash movement, not bonus movement or any item that do not come with cash flow. Exactly. So that is it. But here they didn't tell us anything from the footnote. So we assume that is what? Cash. So the entire 15,000 is what? Is cash. But sometimes they will tell you that a part of it wasn't cash. A part is like non-cash. That's a bonus. Great. Income surplus, we won't touch it. Where does dividend, everything, dividend given, profit is also given. We don't touch income surplus. Leave it like that. But make sure that you balance it. You balance the income surplus. You compare the opening balance, add the profit of the tax to it, less any dividend declared or paid. It will be equal to the closing balance. Non-current liabilities, debenture. We have 25,000 at the start. At the end is what? Dash. What doesn't lies? It means they paid all the 25,000, right? All the 25,000 has been paid. That's the meaning. All the 25,000 has been paid. So will it be inflow or outflow? Outflow, good. Under what? Financing, agreed. So we put it there. Current liabilities. We've talked about trade creditors. You're going to use that one to calculate what? The cash paid and then the changes in what? Working capital. Tax paid to, you calculate the tax payable, you calculate the tax paid. You pick the opening balance, you add the income tax expense, you less the closing balance from it, then you are done. The income tax expense is what? Happen to be 1950. Good. So 1950. Great. Then you find the tax paid. And that's the end of the game. So we've scanned through every aspect of this question. Please, when you go home, I need a full section of the solution. A full section. It has been solved. So if you send the solution, I'll forward the solution to you back. Full section. If there's any question to let me know. If you do have any question, kindly ask. If there are no question, then this is how far the good Lord will bring us. On that note, that is the end of cash flow statement. Next week, we are doing ratios. Please, I'll upload the video. In fact, the videos are there already. So I just forward it to you. From now, this weekend, in fact, I'm going to use to do cash flow. So I'll not forward it. I'll wait when I'm done with the cash flow. Okay, some of you have done, so I can still forward it. So I'll forward it, okay, so that the burden moves from me to you. So I'll forward it during the weekend so that you go through before next week. Next week, I'm only solving questions. And the question I'm solving is in the video. So if you go through it, to be nice. Let me explain in advance. The video, it contains it's a lot, up to 18 chapters. You have to watch all of them. The reason is this: they are very short. Some are 30 minutes, 26 minutes, 30 minutes, 10 minutes. So that's why they are plenty like that. It's like Chiwa, part 1 up to part 18. Okay. That is it. Only the very first one, which is 2 hours. That one summarizes everything about cash flow. The very first video. So, sorry, summarizes everything about the ratios. Okay, so this is how far the good Lord will bring us. On that note, call it successful day. Thank you very much for coming. Have a nice day. See you when I see you. If you do have any question, I'll still be on standby. Can ask the question. Thank you too for coming.